Kia ora te whānau. Thank you for joining us all today. We appreciate you all taking time out of your busy days to be here and to listen to this very topical piece of news and piece of advice that's coming through from Iain here at BDO. Ko Kat tōku ingoa. My name is Kat. I'm the new General Manager here at Scaffolding, Access and Rigging New Zealand. And I think all of us would have recently seen in the news or felt it even in the daily operation of our businesses that the construction sector is under really intense financial pressure. Especially subtrade companies have been hit. January alone saw about 115 liquidation applications coming from across New Zealand, and construction was really leading that trend, unfortunately. So to help us understand what the real risks and some practical steps that we can take as business owners are, we're joined by Iain Shephard, a partner at BDO, specialising in business restructuring. Iain comes from more than 25 years experience in liquidations, receiverships, voluntary administration and turnaround management. This includes a lot of direct experience working with scaffolders and access organisations. And I just found out today that he has managed one very close to my home here in Horokiwi in Wellington. So just before I hand over to Iain, I want to do a little bit of light housekeeping for us all. We have everyone with their cameras and mics off at the moment. But if you want to ask a question, you can do so through the chat box in the Q&A section, or you can raise your hand, and we've got somebody managing that in the background to get the attention of Iain. I will read out any of the questions throughout the session so that we can have some live interactions. But if you want to raise your hand, Sarah will take you off mic and you can talk directly to Iain, and we'll get a bit of a chat going on. This webinar is being recorded so that we can share it later with our other members and other people who are not able to make it today. If you are not happy with being recorded, keep your microphone and your camera off. So now that that's done, I will hand over to you, Iain. Thank you so much for being here today.
No problem, Kat. Thank you very much, and welcome everybody. As Kat said, I've been around the traps for quite a while. I've been lucky or unlucky enough to deal with a few scaffolding organisations. One back in the late 90s that had scaffolding on offshore rigs off Taranaki, which was a very interesting situation that we had to deal with. This is necessarily quite brief and high level. There are going to be some intricacies. As I said to Kat earlier before everyone came on, I'm extremely happy to take questions the whole way through and at the end, but also in due course, if people just want to give me a call and just ask me a question, I'm extremely happy to engage and hopefully able to help and answer any queries. Now, the first thing I wanted to talk about was the early warning signs. Now, my opening statement, they can be very obvious. Delayed payments and excuses, we're all familiar with them. I've put the words reduced professionalism in there, and I actually think that's quite important. At risk of showing my age, one of the things that we used to do quite frequently when we'd walk into an office is you glance around and you see unopened mail. Now, obviously everything's email these days, but there'd be a stack in the corner and there'll be those letters, the letters from your suppliers that you hadn't paid, and there was just an awful lot of reduced professionalism. Lesser quality products, part payments or round sums, industry rumour mill. Now, I wanted to talk about part payments and round sums because that leads us on to a thing that I haven't actually verbalised in the page, but voidable preferences. Now, they're those nasty situations where a liquidator can look backwards and potentially claw money back from suppliers that have been paid. And one of the things we look for as liquidators is round lump sum payments. You might have a client that owes you $27,683 and you get $5,000, $5,000, $10,000, $5,000, and those lump sum payments stick out and are a warning sign, a clear warning sign. but also a trigger for a liquidator to look pretty closely and see whether they should be clawed back. Now, I know that's the bane of a lot of people's existence, and many of you may have had a horrible letter from a liquidator saying, hey, we think that the money you've received needs to be clawed back. It is a necessary evil. The thought behind it is that all creditors need to be treated equally. Now, what there is, and I'm going ever so slightly off piste here, and I apologise, but what happens is the New Zealand Companies Act says that all creditors need to be treated equally, and occasionally directors have a penchant to try and prefer those creditors that have, for example, personal guarantees. So they'll make sure that all of their creditors that have personal guarantees are paid, and the ones that don't aren't. And so a liquidator is charged with making sure that creditors have been treated equally and fairly. So those part payments, round lump sums, and reduced professionalism are probably the biggest ones there. Industry rumour mill, we all get the phone call. Have you heard that Fred stopped paying his bills or didn't pay his wages last week? So they're the early warning signs that you need to look out for.
Ian, can I just ask in there, you say that there's a clawback of payments that at some point you might have a liquidator call you. Is there any sort of time limit on that? Is it if it was 3 years ago, if it was 18 months ago?
They amended the legislation a couple of years ago to give what they called more corporate certainty by limiting those timeframes, because a liquidator used to be able to look back 2 years, but more than that, a liquidator was running on a statute of limitations of 6 years. So technically, a liquidator could look at a transaction, 5 years into a liquidation that happened 2 years before the liquidation. Now, it would have to be pretty exceptional for that to be clawed back, and there has been some judicial criticism of liquidators not acting promptly. But as a consequence of that, they've changed it. So related party transactions, a liquidator can look back 2 years. They are transactions where a director may have preferred himself or a shareholder or a related party. However, trade creditors these days, the look back from a liquidator is only 6 months prior to the liquidation.
Yep.
And the statute of limitation for a liquidator has been reduced to, I think it's 3 years. So the effort there is to give more corporate certainty. It is fair to say that that voidables still exist, but to a much lesser extent than perhaps they have in previous years.
Yeah, it's just an interesting one. If you receive that $5,000 or that $10,000 lump sum, maybe you leave it in your cash flow for 6 months to be sure. If you've heard a little bit of the rumour mill, if you think there's been a little bit of a change in the temperature from that particular contractor.
Yeah. If you have good debt recovery and actually get those payments, you ought not to be punished for it. So I realise I'm contradicting myself, but what I've always advised people when I've had someone phone me and say, bloody hell, I've had this letter from the liquidator, I've said there is always a deal to be done. So let's say that creditor A got 10 grand and Mr. Liquidator comes and says, I want that 10 grand back. Creditor A initially would deny it and say, no, I'm not giving you that back. But to avoid costly litigation, here's 5 grand, bugger off. So by accepting those monies, I don't think you can ever worsen your position. And typically there's a deal to be done with a liquidator. So hopefully that addresses your question, Kat.
Thank you.
What do you do? Obviously, shorten payment terms, stop extending credit. One of the things to be aware of is, let's say you actually have your clients give you personal guarantees when you're supplying them goods. If the credit limit on your account is $20,000, and that's what the personal guarantee was signed in respect of, if you end up giving the customer $40,000 worth of credit, there's a significant risk that the personal guarantee is limited to the amount that was on your initial credit application. So that's just a little fish hook to be aware of. Now, I want to take a little bit of time to talk about the Personal Property Securities Act, the PPSA. Now, this has the potential to be extremely technical. The concept of title has been replaced by the concept of priority. Now, I'll use a different sort of example, right? Let's say you're a contracting firm and you've got a truck on hire purchase with UDC Finance. For UDC Finance to have claim to that truck, they need to have registered on the Personal Property Securities Register. Now, the register underpins the legislation, so the register is a publicly searchable notice board, and that register shows who has interests in various goods supplied to that company. Now, when you think about it, obviously title to that truck was never intended to pass from UDC to the client until the client had paid UDC all of the monies they owed. However, the concept of title has been replaced by one of priority. So you have a bank that registers an overarching security interest that says, look, we've got everything. Then you have the likes of, using UDC as an example, and they register to protect their truck. And when they do that in the correct way, it gives them priority in respect of their truck as opposed to the bank, and so on and so forth. So where I'm going with that, and let's use an example of Arrow Construction. Now, I ended up dealing with the Arrow Construction matter some years ago, and some of you may want to start punching the screen or getting very angry. Arrow was obviously a large construction firm, and there was a significant amount of protection and scaffolding and so on and so forth. For the supplier of goods in that situation, you are very, very, very well advised to have protected your position by using the Personal Property Securities Act and registering on the register to protect your position. So what happens is Mr. Receiver or Mr. Administrator walks into Arrow, you search the register and you see who has claims to goods. Now, there might be competing interests, and therefore you've got to resolve where priority lies. And as I say, I don't want to get too complicated. But if Scaffolding Company A has registered their interest against Arrow Construction and registered it correctly, and I'll touch on that again shortly, registered it correctly, then they ought to be well protected, and the receiver can't simply say, hey, thanks for the scaffolding. I'm actually now on notice that that scaffolding belongs to Scaffolding Company A. What you need to do to protect your position is have a Personal Property Securities Act clause in your terms of trade, and then you need to register that on the Personal Property Securities Register, which creates that notice board.
So now, would you register every piece of property, or only once this company goes into?
No, you must have registered it when you first start supplying them. So when Scaffolding Company A first got involved with Arrow Construction back in 2014, do it then. And it, again, subject to some technicalities that I don't want to go into, then your registration is there. If you do not have it registered when the company falls over, then it is using technical language deemed to be unperfected, and as such probably loses priority. So and let's think about it. I mean, Arrow Construction might have 30 different construction sites around New Zealand. So you word your terms of trade with Arrow Construction broadly enough so that every item of scaffolding that you've supplied on a hire basis, on a lease basis, or whatever, is covered at any one of their sites around New Zealand. So you must have it registered. My advice is you should have it registered before you start supplying. And if it's contained in your terms of trade, it just becomes part of your account opening process so that you are protected. It creates what's called a purchase money security interest, or a PMSI. and that will give you priority over all of the other creditors and all of the other creditors that have got registered interests, because they will be registering in respect of their goods. Banks typically have general registrations over everything, but by ticking the right boxes and making sure that you have a purchase money security interest, you are ahead of the bank, and hence Mr. Receiver has to acknowledge that you are there and that your goods are protected. So I've probably gone into maybe more detail than we ought, but the Personal Property Securities Act can be your best friend because it protects you with your goods. Now, it doesn't necessarily get your money back, but it means you get your goods back. All right. There can be other ways that you can actually try and get your money back, maybe by putting tracing clauses in to trace into proceeds and so on and so forth. But one of the biggest things when we walk in as liquidators and receivers, in situations we've had with many construction companies, hey, that scaffolding's mine, that porticom is mine, it's not yours to deal with, Mr. Liquidator, it's not yours to deal with, Mr. Receiver. So using that piece of legislation properly, it protects your position to the best you're able to do. Obviously, you also have the final option of stopping trading with them altogether. So that's my comments on warning signs. Your best friend is to protect your position in respect of the assets using the Personal Property Securities Act. What happens if the client does go under? You can secure your assets physically. The number of times that I've had some very aggressive suppliers march onto site and start taking assets. As an insolvency practitioner, we don't like that and we don't let that happen. However, we also try and manage it in a careful and considered manner, because people are obviously concerned about their assets. And again, coming back to my protections that I've mentioned in the Personal Property Securities Act, using your industry as an example. If you have a scaffolding company, the example that I've got on the screen there is the one that Kat was referring to. That beautiful photograph is a contractor's yard called Tenga Pickering Contractors. We were appointed liquidators to them in, I think it was July last year. It is literally, that yard is just down the road from Kat's residence. They had a whole heap of temporary fencing. The creditor had registered their security interest correctly on the Personal Property Securities Act, or on the register using the Act. We were able to say to them, don't panic, please just let us deal with your fencing in an ordered fashion. We note you've got a registration. That means that your interest is protected. Please bear with us while we work through things. So that was a real world example of us, dealing with someone that had protected their position.
How long can it take from the notice that they're going into liquidation to being able to claw back some of your assets? Is that variable depending on the size of the company, or?
Variable depending on the entire circumstances, Kat, because and if you have a look at my last line there, it's also worth noting the IP's personal liability regarding ongoing hireage. If the insolvency practitioner wants to finish a contract and therefore still requires the use of the fencing, there's the Companies Act says that a liquidator or an administrator are in certain circumstances personally liable for ongoing hireage. So it would be up to the insolvency practitioner to actually reach an agreement with the supplier to use the equipment ongoing. Mm-hmm. So the beautiful answer to that is quite simply, it depends. But most experienced insolvency practitioners are used to reaching arrangements with suppliers. Some suppliers may turn around and say, no, not interested. I don't even care if you're going to pay me. I want my goods back.
So we've just had a question from the room. What if I have a clause in my conditions that I own the scaffolding and can take it back? And well, that's in the scaffolder's clause, yep. Terms and conditions.
Yep. So that I'm going to loosely use those words. That's an old-fashioned reservation of title. And it comes back to my comment about title versus priority. What you are trying to do is to say, hey, title remains with me, but title has become irrelevant. It is an order of priority. So if a bank has an overarching security and you, exactly in the circumstances in which you've just asked that question, haven't used the Personal Property Securities Act correctly and simply tried to retain title, the bank might end up with priority over your scaffolding. So you must get your terms and conditions very, very clear so that they come into the current legislation. It's not just I retain title to these goods, they're mine. It's the Personal Property Securities Act, your best friend. I know the questions just come up here. I already own title. As you know, sorry, Kat, can you just read that question again?
So Marcus said, I already own the title, and the organisation that's in liquidation are only hiring.
I know, but there's a section in the Personal Property Securities Act that quite simply says that the priority is what's relevant, irrespective of who has title. I know you find that slightly strange, but the concept of title has actually gone from the orders of priority within insolvency situations. Okay, so, and that's why I was, in my previous slide, your best friend, and I really want to emphasize the Personal Property Securities Act. That is the best way. Well, if a question has just come up, if I don't use the PPSR, then if you don't use the PPSR, you are at risk from a receiver saying you have lost priority to the bank. I know it's a strange concept, but it does actually happen. Now let's talk about it again a little bit briefly, because I know it's a hot topic. Using the PPSA is actually yeah.
So then there's a question of natural justice,
Yep.
which I think everybody does talk about in situations like this, where potentially storming on site, putting it in the back of the truck, and just try and stop me, mate.
Yeah, and as I said at the start, secure your assets physically. We've all been there. That's why in major insolvency situations, security guards get in, things get blocked off, things get protected. Might is right. I'm not going to argue with you, but technically you have lost priority and should not do that. Now, as an experienced insolvency practitioner, I've only ever not been able to defuse a situation like that on a couple of occasions. But coming back to what before that storm on site question throughout there, using the Personal Property Securities Act, using the Personal Property Securities Act is actually very, very simple and very, very cheap. The moment you get used to doing it, it's easy and it guarantees your protection. So I can't emphasize strongly enough that that is the thing to do. You have having the terms of those specific terms in your terms of trade, easy peasy. Then registering on the Personal Property Securities Register takes about 7 seconds. So it is literally easy and it protects you. Right? So
are there any sunset clauses on the PPSA duration? Do you have to re-register at a later date?
You do. They last 5 years. They last 5 years, but you get a reminder to say, hey, your registration's coming up for its 5-year renewal. Do you want to renew it? So if you've got consistent clients, you get that renewal. One piece of advice I would give is be very careful of email addresses. Mary at XYZ Limited Scaffolding, right, does the Personal Property Securities Register. Mary then leaves in 3 years' time and her email address isn't monitored, and the reminder comes up and it falls through a crack. So have a generic, PPSR at XYZ Scaffolding or office at XYZ Scaffolding, just so that you're making sure that you're not letting that sunset that you've just described, Kat, fall off. we have had that as an example where a wholesaler of motor vehicles importing from Japan had a personal property securities register over a motor vehicle dealer, and their registration dropped off, and all of a sudden the vehicles were available to the general body of creditors because the security interest was deemed gone. So it is important to monitor that, but quite simply, it is easy to use, and used properly, it protects your position. I can't emphasize that enough. I know there's the might is right. I know you charge in and grab all your scaffolding, and I know that they might only owe you $5,000 for the hireage, and you've got $100,000 worth of scaffolding on site. Doesn't matter. Doesn't matter.
I might move us on from this topic just because we've covered it quite intensely.
Sure.
And we'll come back to it in the Q&A afterwards if there's still some questions on it.
I think Mark is just saying might is right, and hey, Mark, that works sometimes, not all the time, but it's easy to protect your position. All right, so what options do you have if you're struggling? I've enclosed some photos there of a company, and I think that comes back to my warning signs. What a mess! This was a receivership that we did out in Lower Hutt, and the lack of professionalism, the complete and utter chaos. Seek professional advice and seek it early. Do not be afraid to come and talk to someone like me. It doesn't need to be on the record. It doesn't need to be public. And all too often, as an insolvency practitioner, we find ourselves as an ambulance parked at the bottom of the cliff. If there is a viable core business and we can save it, and we've done it many times, don't get me wrong, some of them have fallen over into liquidation, into receivership, etc. But if there's a viable core business and we can put some things in place, and we can potentially look at doing deals with creditors, doing deals with the Inland Revenue, creating some sort of moratorium to freeze the creditors while we work through things, talking to professionals and doing it early, don't put your head in the sand. And that's probably the best bit of advice that I can give. So many times people say to me, I wish I'd come and talk to someone like you earlier. I might have been able to save things, because they come and talk to us when it is far too late. Which leads me on to my far too late comments about Inland Revenue. What we are noticing at the moment is that the large number of Inland Revenue liquidations, a heap of them are what we loosely call zombie companies, whereby the company has, for all intents and purposes, disappeared, but they have a whole heap of Inland Revenue debt. We are seeing a lot of small business loans that were dished out over COVID coming home to roost. Allegedly, the Inland Revenue are starting to get harder. I think there's been quite a bit of criticism in the last 2 or 3 years that they haven't been hard enough. We are noticing them starting to get harder and harder. The photograph I've got there was a little honey company that I did up in the central North Island. The Inland Revenue had let them get to $3 million worth of debt. The beauty of things like that is that I can talk about it publicly, because our receivers' reports are public reports. You can search them on the company's office, so I'm not breaching a confidence by saying that. Now,
well, there was some talk at one point of IRD having a public record of tax debt, PAYE. You laugh, is it not likely to go ahead?
Technically, in some situations, it is able. I've been talking to the New Zealand Credit and Finance Institute about that, and yeah, that would be brilliant. Politically, don't think it's ever going to happen. In some circumstances, it can happen. There are legal abilities for the Inland Revenue to register on the likes of Bay Corp for arrears, but they have to jump through so many hoops that they simply don't bother. Because if Inland Revenue debt was searchable on, again using old-fashioned language, on a Bay Corp credit check or whatever they use these days, then that would help people know whether or not there's IRD debt. So I laugh because it's been spoken about, and in many respects is technically able to be done, but the technicalities behind it are so onerous that it doesn't actually happen. I have to say that right now they are getting harder and harder and harder. And I've used some words there, integrity of the tax system and duty to obtain highest net return. We've had some situations recently where I believe there is a viable core business, but there is substantial inland revenue debt. And let's pluck a number. Let's say that debt is $1 million. Hey, inland revenue, here's $600,000 in full and final settlement. Can we write off some penalties and write off some interest, and can we get back to being a good corporate citizen? And they're saying no. Now, whether they should say yes or no is probably open to debate, but I've been a bit incredulous at their refusal to do deals that I think are in the best interest of New Zealand Inc. Mark has just asked the question, why are they saying no? For the two reasons that I've said there. They quote, "We are doing it for the integrity of the tax system." I then throw it back in their face and say, hey, but you've got a duty to obtain the highest net return over time, so doing the deal is in everyone's favour, and they just refuse. So it becomes a conflict situation, Mark, and sometimes quite hard to deal with. So, Kat, I realised that I went quite heavily into the Personal Property Securities Act part of it. I am absolutely convinced that that can be the best friend to protect your position. I don't know if there's any further questions, if someone wants to raise a hand and ask a question or throw it out online. As I've said, I'm always really happy for someone just to pick up the phone and call me and talk it through. There's warning signs, there's ways to protect, and there's ways to act early if you are struggling in your own business. So hopefully that's been a little bit useful, Kat.
Yeah, absolutely. I've definitely learnt a thing or two as a business owner. I haven't seen anyone's hands raised. We do have a couple of minutes. If anybody wants to pop one up there, we'll keep an eye out. I think what I've really taken away is some of those early warning systems. I probably didn't think of them as something to place as how capable a business is, whether they're acting in a professional manner compared to how they were last year, whether they're a bit messy, whether they're a bit late. I think as subtrades, we are used to being paid last, which is a sad truth of the construction industry. So it is nice to have some other early warning systems apart from the bills not being paid. Research the Personal Property Security Register. Become a priority. Be the number one that's going to get paid out of whatever chaos happens after that. And then I loved your line, know when to stop trading with them.
Yeah.
It's hard. It's so often we base these things out of relationships. It's people we worked with for years, and we have 7, 8, 9 years of good relationships behind it. And being able to say no is a real strength. Is the PPSR a priority before the IRD, Iain?
With assets such as your scaffolding assets, yes, absolutely. I'm going to use very old-fashioned language and refer to assets in two different categories. Floating assets or liquid assets, if you like, let's call it inventory and receivables. The IRD comes first out of that typically, but fixed assets, and this wording has all gone out, alongside the title and priority, but fixed assets, tangible assets, diggers, trucks, motor vehicles, scaffolding are fixed assets, and you will always have priority over the IRD, but more importantly, you have priority over other creditors. And that's why, Mark, the might is right. It doesn't always work, and that's why the PPSR is a very, very good, cheap, cost-effective way to give you the best protection possible. I thought I saw someone's hand up before, Kat, did I?
We saw a thumbs up come through. You must have been talking along the lines of what they wanted to hear.
Sorry.
That's all good. And I'll just quickly, could liquidators sell scaffolding to pay debts?
They can if you have failed to protect your position, because they become available to either the general body of creditors or they become available to an overarching secured creditor like a bank. So that's why I'm saying protect your position.
Become a priority, guys.
Yeah,
Research
so
that.
Last chance, anyone, if you want to raise your hands up the top there, you can see the hand icon that just says raise. If you click that, I'll unmute you and you can ask your question in person.
And I'll just quickly add that last page of if you yourself or your organisation is struggling, seek help. You can seek help from professionals. You can come to us at SANS. We can link you into others in the network who may be able to support you. We've got people like Ian at BDO. We've got people like JB Morrison's, the legal team that know a lot about scaffolding. There's a lot of professional help out there that we can link you into. So try not to bury your head in your sand. When it's your own business, it can be very easy to do that. And
Just,
we've got,
yeah, Kat, Mark has just said that SANS should help you out. Maybe what I should do, and I'd be very happy to do this, Kat, is just give you a typical Personal Property Securities Act clause out of some terms of trade.
Yep.
I'll make sure that names are redacted so that you don't see who it is. And I might get you to flick that round, even the attendees at this meeting, because by having a clause like that in your terms of trade, and therefore doing the registration on the Personal Property Securities Register makes it real easy. So why don't I send an example clause that people can just whack in their terms of trade, Kat?
Yeah, beautiful, mate. That would be absolutely amazing. Thank you, Ian. That's really practical. That's really awesome. I've definitely learned a few things and just really appreciate you taking the time out of your busy week to be here to present to us today.
Always happy to take questions if someone wants to give me a call and have a chat. Very relaxed about that.
Yeah, absolutely. You can get in touch with Ian through SANS or just Google his name. He has his cell phone and his email address up on the BDO site. After the conclusion of this webinar, we'll be sending through an email with the webinar recording if you want to share it to anybody. And we'll also follow up with those dummy clauses from Ian once we get them as well. So thank you, team. Thank you to the audience. Thank you to the questionnaires. And thank you again to you, Ian. We hope to see you all on future webinars. And so from us at the SANS team, I want to say ka kite anō and have a great evening, guys. I hope you enjoy your dinners.
Thank you. Cheers.
Cheers, Ian. Thanks so much.